Hello everyone, I am Dr. Jamuna, Associate Professor of Management from Tecnia Institute of Advanced Studies. Now we will see a lecture on the second capital structure theory, that is net operating income approach. Now we want to highlight the net operating income approach which was advocated by David Duran based on certain assumptions. They are: number one, the overall capitalization rate of the firm, that is KW, is constant for all degree of leverages. Number two, net operating income is capitalized at an overall capitalization rate in order to have the total market value of the firm. Thus, the value of the firm V is ascertained at overall cost of capital, that is KW. Now, let us see the formula. V is equal to, that is the value of the firm is equal to EBIT divided by KW. Since both are constant and independent of leverage, the market value of the debt is then subtracted from the total market value in order to get the market value of equity, that is S minus V minus T. Then the fourth one, as the cost of debt is constant, the cost of equity will be KE is equal to EBIT minus I by S. Under this approach, the most significant assumption is that the KW is constant irrespective of the degree of leverage. The segregation of debt and equity is not important here, and the market capitalizes the value of the firm as a whole. Thus, the increase in the use of apparently cheaper debt fund is offset exactly by the corresponding increase in the equity capitalization rate. So, the weighted average cost of capital KW and KD remain unchanged for all degrees of leverage. Needless to mention here that as the firm increases its degree of leverage, it becomes more risky proposition and investors are to make some sacrifice by having a low P/E ratio, that is profit and equity ratio. Here remember that the cost of equity is increased with the corresponding increase in the leverage. Thus, if the cheaper debt capital, that will offset by the increase in the total cost of equity KE, and as such both KE and KD remain unchanged for all degrees of leverage. That is, if cheaper debt capital is proportionately increased and used, the same will offset the increase of cost of equity. Hope you understand the topic of NOI. Thank you so much.